Ghana's central bank on Wednesday delivered its biggest rate hike ever, a 300 basis point increase to 22% at an emergency meeting to address the economy's rapid deterioration amid crippling inflation. The hike comes just 3 weeks after it kept its monetary policy rate unchanged at 19% and said it was waiting to observe the impact of a series of record-breaking hikes.
Ghana's central bank has delivered its biggest rate hike ever amid crippling inflation. At an emergency meeting on Wednesday to address the economy's rapid deterioration, the main lending rate was raised by 300 basis points to 22%. The hike comes just 3 weeks after the Bank of Ghana's Monetary Policy Committee left the rate unchanged at 19%, saying it wanted to observe the impact of a series of record-breaking hikes. Since then, the SABC currency has continued its steep decline, losing more than 6% against the dollar on Wednesday alone, according to data from Refinitiv Icon. That brought total losses for 2022 to 39%. Consumer inflation rose to 31.7% annually in July, its highest since 2003. The government's top statistician has warned it's not possible to say whether inflation has peaked. Having initially said it would not turn to the International Monetary Fund for help, Ghana is now in the early stages of negotiating a support package. Razia Khan, chief economist for Africa and the Middle East at Standard Chartered, said the hike could help demonstrate that the West African country is committed to reaching a deal. In a statement on Wednesday, the Monetary Policy Committee partially blamed Ghana's current economic troubles on external factors, including a strong dollar and tighter global financial conditions.
All right, let's talk a little bit more about this with economist Joe Jackson. He is Director Business Operations at Dalex Finance. Thank you so much for speaking to us. I mean, you've heard from that report some of the contributing factors, but has this been a long time coming? I know a lot of countries, particularly developing countries, have struggled to rebound their economies on the back of COVID-19. But this emergency meeting in particular that saw the interest rate hike, what spiked that?
Okay, well, Ghana, like many other nations, has suffered from COVID, and then the aftermath of the continuing war in Ukraine, and so we've all suffered from inflation. But a few in the half-year review of the government, we found out that the government had deficit financing to the tune of 11 billion cedis, which is over $1.2 billion. And that deficit financing, I think, fueled the inflation. And so even though we're suffering the same things everyone is, this has been fueled by the deficit financing. And some of the results we're seeing is a precipitous drop in the value of the cedi.
And I mean, obviously, while in conversation with the IMF at the moment with regards to Ghana's debt, you've got to be seen as a country as willing to do the most to create conducive conditions for lending. But what is the impact of this on consumers themselves? And I want to understand the rationale, obviously not being an economist, speaking from a layman's terms, how not tinkering with monetary policy is going to help balance things.
Well, first of all, for the consumers, they're going to feel this in an increase in their interest rates. Those who have mortgages with floating rates, those who have consumer loans with floating rates are going to see the rates go up in the weeks ahead. So that's going to affect them directly. In addition, the downside to such a huge hike in the monetary policy rate is that businesses are going to feel it. And so we're going to be seeing a slowdown of the economy. So you're between a rock and a really hard place, because the challenge is this: do you allow inflation to run away, Or do you try and put brakes on the economy, hoping to slow down inflation in the process too?
I mean, my understanding is that consumer inflation has already risen further than 31.7% annually in July, and that's the highest since 2003. And I believe that your statistician general has said that it's not even possible to say whether inflation has peaked.
Well, one thing we're sure about, it hasn't peaked, because the producer price inflation, which is a precursor to the producer price index, which is the precursor to the consumer inflation numbers, is still tracking upwards. So we're expecting in the next few days and weeks to hear even higher inflation numbers. But the good thing in all this is that right now, this is a good time to be exporting. This is a good time to be buying assets in Ghana because prices have crashed. So maybe it's a good time to invest in agric. It's a good time to invest in mining and the likes.
But for the ordinary man on the streets, it's very well and good speaking about these opportunities. We've seen street demonstrations against the economic hardships that are currently underway.
It's a tough time. It's a really tough time. Inflation is on the up. It doesn't look like there's an end in sight. Jobs are not being created. The CD is going through a tough time. So these are tough times. These are really tough times. And they would require the powers that be in Ghana to be able to unite the country behind the measures that they have to take to correct this current mess.
So I believe that the central bank overdraft is supposedly helping to fill the gap, but for how long, especially given the external shocks that the government is pointing to as being beyond its control. So I'm just trying to understand how this is also going to impact the negotiations in terms of the support package for the IMF.
Well, first of all, the IMF engagement is clear. It is clear that it won't really take off until Q1 of next year. So the government has to find a way of muddling through the next few months until Q1 of next year, where some relief will be available. But one thing is for sure, raising the MPC rates, etc., is trying to signal to the IMF that Ghana may be starting to face up to its challenges.
And just in terms of your currency, is it these actions, are they going to be enough to stabilize the CD alone?
They are not going to be enough to stabilize the CD. The CD will fully be stabilized when we get the IMF deal done, and so there's a bit more inflow of dollars. Over the next few months, we expect a lot more turbulence with regards to the CD. But these measures should be able to slow it down so that it doesn't go into free fall.
All right. Thank you so much for your time. Much appreciated. Joe Jackson is an economist. He's Director, Business Operations at Dalex Finance. Thank you very much.